Hey everyone, it's Augie Anderson. Welcome to Augie TV. I've got a great episode today. I have Debra Harper with Element Home Loans, and I have known Debra, OMG, for decades. I've known this woman for more than 20 years. So when I tell you I have somebody credible with financing, this woman knows her stuff. And she went through the real estate tsunami of our times and survived it. And she's excellent. And we are going to cover a couple things today, but ultimately we're also going to be telling you the 3 things you must know to obtain a mortgage in this challenging real estate market. Debra, thank you for joining me today. I really appreciate your time. So what I want to know before we get into the meat of things is it is a challenging market, isn't it? It's not, we talked about this because I started with this downturn, but it's not really a downturn market, is it?
No, and really it's challenging because people don't remember normal times of what money cost and when you're borrowing money and things. So I think that people, there's so much media talking about things that could be true and not true, selling, papers and websites. And there's so much social media now talking about things that people think it's a challenging market, but it's really moving into a normal market.
A normal. When you say normal, are we talking about a stable market?
Well, we're talking about normal interest rates and normal cost of money, and then the normal appreciation of values going up. So
okay, that makes sense. So what I'm dying to know, everyone's dying to know this every day. They ask me, I'm not someone that follows it that much, but what's the interest rate today?
Okay, just to preface it, the interest rate is based on people's credit scores and loan to values and things. So it is a range of rates, but I would say, to be fair, to encompass all of that, between 5.5% and 6.5% interest rate to encompass everyone.
And so the better your credit is, the better your rate is. Is that not true?
That's correct. Okay. That's correct. It's all risk-based pricing now. So the risk encompasses how much you're putting down, what your the middle credit score of the lowest middle score of everyone on the loan that's borrowing, and then the loan product, what type of product they are. So it encompasses all the risk of that. So
what's interesting to me is, how did we get from this ridiculous market a year ago? This time it was a stupid market where people were paying over the appraised value. How did we get from that to this?
Well, I think I don't know why people were doing that, to be honest, but I think they were afraid they weren't going to get the home that they want. And then the rates were so low, and everyone knew rates aren't going to stay that low forever. I think they thought that they were, paying over it and getting the house and getting the lower rate was a benefit to them. But to me, the opposite is true, because I think that now paying the normal price or the current value, and then so you pay a higher interest rate, you're still paying the same thing because that money was spent. So whether you pay it in a monthly payment or pay over the value of the home to get that, it equates to the same thing. So being afraid to lock into a rate now, really, it's no different to me.
It is no different, is it?
Yeah.
So because I feel like a lot of buyers are, I really feel like buyers are going, I'm just going to wait for the rates to come down again like they were. Is that really going to happen?
No, I don't believe so. I've done this for 30 years. So I started in 85, and the rates that we had during that time was the lowest rates I've ever seen in history. So when I started in the business in 85, I think the rates were probably around 10 or 11%, somewhere around that. My first house was a 13% rate. So it's just, prices are higher. So the effect of higher rates in the payment, means that it's harder to qualify, or you can, your payment's going to be more than it would have been. But, you can't have low rates and good returns on investments at the same time. I mean, it's just, it's always a cyclical market where it's up and down, it's just always going to be a changing thing, and the economy has a lot to do with that. So,
right. Well, I think that pretty much sums up some of the questions that I have. So what are the 3 things that you feel buyers, like the really important things buyers need to know to really be prepared to get a mortgage?
Well, number one, a lot of people wait to the last minute to get their pre-approvals, and they're ready to put in an offer. And in certain price ranges, other people are looking at those homes too. And so here they want a pre-approval and they want to put a contract in at 9 o'clock at night, but they've never gone through that step of making sure that they actually can qualify. They really need to get their income docs together and do a real pre-approval. That's what I like to do, where I verify their income. That way there's no surprises, because when you get into contract, you're spending money. So you need to make sure that you're going to be able to obtain that loan for sure. And then if there's any credit issues, I can walk them, or another lender can walk them through the process of actually what they could do to enhance their credit and give them time to do that, instead of being at the last minute too when they're in a hurry, because if they're 3 months out, you really should be getting pre-qualified, that 90 days in advance, because if there is stuff you can do, it does take some time to get your credit score adjusted if you were trying to, pay some things that would boost your credit score to help you with the rate or the product, because there are minimum credit scores for each product. So I think that's important, and they need to have their income docs together, a thought of where their down payment and closing costs are going to come from. You'd be surprised that a lot of people call you to get pre-qualified, but they haven't really thought of how they're going to pull that money together. So then I can talk to them. Yeah, no, but it's, and then you can talk to them about, places where maybe they could get that money, but they haven't thought about, like 401ks, down payment assistance, which is not a lot of available, and then gifts and that type of thing. So yeah, so I think a pre-approval is really the first step, and most people don't want to show houses to someone that hasn't done a pre-approval. So
I mean, you're going to drag them around to see houses and then they can't qualify it. That was a gross waste of time.
Yeah. And, people get offended. And then I find that people that don't want to get pre-qualified, they pretty much already know maybe they can't, but they wanted to see the house. So, I mean, there's lots of reasons. But, a lot of people, I think, you do the pre-approval. So that means we can pull their credit. So credit is the main thing that affects everything, obviously. So we can do a soft pull to start with, which doesn't affect their credit scores.
What does that mean? What time out? What does that mean?
A soft pull is done through the credit bureau. It comes from one bureau, and the bureau itself, the buyer authorizes it, and the bureau itself does a pull for us, but it's not where it affects their credit score. It doesn't show up as an inquiry on their credit report.
That's a good thing.
So, yeah.
Worry about that.
Yeah, everyone does. So normally, if you have a real high credit score, you don't really need to worry about getting your credit pulled. A lot of people think it's going to hit them a lot of points, but when you're doing a mortgage, all the pulls are going to count as one pull for 30 days if you're going to shop around and do things like that. If you're buying a car, unfortunately, they pull a lot more because they're trying to find the bank that'll give the best deal for them to lend on a car. So you'll see maybe 10 or 20 pulls, actually. I mean, I've seen quite a few, Whereas on a mortgage, you normally only see where people have checked once or twice or 3 times maybe with different lenders. So, but a soft pull doesn't let you run it through automated underwriting and get a firm approval, to know it's going to work. So
Right.
once they decide they want to go with that one bureau, we should be able to determine if it's something that's going to, work, be able to get a product that they want. Then we can do the hard pull through all 3 of them to do the pre-approval.
Uh-huh.
How many points would a hard pull get?
Maybe 3 to 5 points. Yeah, it's not major. Now, if someone has a real low credit score and they've had some pulls through other things, like try to get a credit card to try starting to build their credit up, things like that, then you may see the inquiries affected a little bit more. And it seems like that people start trying to build their credit up right when they're starting to want to look to buy, which is a little bit late in the process. So,
Right.
and then I see people that are working with credit repair, and I'm not dinging credit repair at all, but you can do all that yourself without paying a third party to do that. And a lender can actually, most lenders can go onto the credit bureau and do a what if simulator, we call it. And if you pay down this, and this will jump you 20 points or 30 points or something like that without them having to do that too. So, because, you get into a lot of money when you start having a credit repair company come in to do that. And they're writing letters to get things deleted and removed because they have 30 days to respond. Which is something that a consumer can do themselves. So when you get pre-qualified, at the same time, we'll recommend things for you to do on your credit that could make a difference for you. So
let me ask you this while we're in this area. So if somebody's really, it sounds like this is more like the first time home buyer, right? This process, do you see this happening with people that have already purchased as well? Really?
yeah.
Yeah.
So, all right. So that being said, then when should you get that pre-approval or be getting prepared for that before you want to really start home shopping?
Well, I think 90 days. I mean, your credit report's good for 120 days. So you have to close within the time that it's going to before it expires. So definitely 90 days in advance, if but there could be things that could come up. Some people, people with good credit generally know they have good credit. But, if there's things that you need to get work on, and find like help with down payment, credit repair, or just even paying down some credit card balances, if you're trying to do it 30 days before closing, that doesn't give time for all of that to work into the credit score and work into the repairs. So having 90 days I think is a good amount of time. And then you seem to always find the house that you want before you're really ready. It seems like the perfect house comes along and you weren't ready yet. So
Right.
Yeah.
So that's
So
really good to know. All right. So that was the number one thing. What do we got for number 2?
Well, assets. A lot of people don't realize how much money they're going to need for closing. So, you're going to have your down payment, but most people have no idea about how much closing costs are. So, and right now we're in a little bit higher priced closing cost time because mortgages do cost more now. So
Why?
Well, the secondary market where we deliver loans to, they're charging more in anticipation maybe that rates may come down, if we do go into a recession. You hear a lot about that in the media. So, that if you're wanting to get a much lower rate and buy it down, a lot of times people are wanting to spend that extra money to do that. Plus, if they're going to refinance it in the future, sometimes that's not the best thing to do anyway, but they need to get an idea of how much they would need to determine, and the credit score determines how much it's going to cost for their mortgage too for closing costs. So, someone with lower credit, it's going to cost them more than someone with a higher credit score. So,
Right. And part of that, I mean, this is part of the closing costs, even though the bank's not asking it, but their funds, they got to factor in the insurance, which has also gone up,
Yeah,
right?
Yeah.
And taxes. as
taxes.
well. So
Prepaids.
you're needing a big chunk of change these days, aren't you?
Yeah, it's gotten a lot more expensive. You used to could say, someone would say, well, maybe it's just about 2% of the purchase price, but depending on their loan amount and all that, sometimes it can be much more than that. So
Right. So you
yeah.
can't use that as a rule of thumb anymore, right?
no, you can't
No.
use that as a rule of thumb, especially when everything's risk-based pricing, so it just depends on the product between FHA, VA, and conventional, USDA,
Right.
those types of things.
Ruth, you got any questions about that?
So far, no.
Okay. All right, then what's our third thing, Madame?
Oh, let's see. Well, I talked about assets and credits, and then documents needed for pre-approval was my third thing, which we started sort of top. So everyone needs to pull together. We're always going to ask you about a 2-year work history. So we always need to know where you've worked for the last 2 years for your income. We're going to ask you a 2-year address history, and you'd be surprised where people can't remember where they've lived for the last 2 years, the address.
Wow.
Yeah. So, and then, it takes about 10 minutes for me. I have I know exactly where to go to ask all the questions that is needed for an application, but then their assets, a lot of times people really don't know how much they have in the bank. So we're always looking at liquid assets, and then we'll ask about things that are non-liquid that maybe if we're trying to think of where they could get their money from for their down payment. So
Now, in the past, it used to be you have to have a reserve as well. Is that still a requirement?
not necessarily. Automated underwriting will tell us if they have to have cash reserves. So if you have a lower credit score and you have cash reserves, it may give us an approve eligible or an accept if it's Freddie Mac. If you have cash reserves where it gave us a refer or a caution before if you didn't have cash reserves listed. So it's case by case.
Yeah. Okay.
That's good to know, because my situation is I don't have any reportable income per se, survivor's benefits, but I just came into some money from an inheritance, and I'm self-employed building a business. So I would have considerable money to be able to put down as a down payment. And I do have my survivor's benefits as guaranteed income, but that self-employed income is very fluctuating. Would that make it difficult for me to qualify?
Well, as a lender, we're going to take your 2 years tax return. So as far as I know, most all regular conforming loans require a 2-year average off of your tax returns of that. Now, there is loans that you can do if your tax returns will not average the income needed through lenders can broker through like a 1099 loan or a bank statement loan and that kind of thing. They still require that you've been self-employed, most of them for 2 years, but there are other ways to do it. But those loans are a little bit more expensive and take a little bit more documentation and that kind of thing. But there is avenues, but generally, if you're going to get an FHA loan or a conventional loan or a VA loan, we're going to average the 2 years of your net income, not your gross income.
Gotcha.
After expenses. So
That's
and no
good to
one
know,
knows what
Ruth. I'm glad you're tuned in.
Yeah.
What's
so no
that?
one knows that usually their net income. They remember how much they brought in, but they don't remember how much they wrote off. So I
Right.
won't generally give a pre-approval without seeing tax returns for a self-employed borrower. Oh, my battery's not charging.
So we're going to wrap it up here. I'm just going to bring up a couple more things. One is I've told you about my thrifty listing plan. Oh, she's froze there. I hope she's coming back in.
Yeah. Think her battery died. Ooh.
Hopefully she can come back in. Well, this is really good for you to know, Ruth, because I think once you, in this next trip here, we need to get you all like really legit.
Yeah.
Let's get you legit.
Yes, ma'am.
And that's gonna, you really, I think this was beneficial. I'm glad you really tuned in.
Absolutely. I wasn't gonna miss it for nothing.
Yeah, she's good. And I've known this gal for a long time. I'm hoping she has a charger to come wrap it back up. Oh, she's gone. Well, that about sums it up. I'm sorry, Deborah's charger. Oh, maybe she's coming back in here. Oh, there we go. I'm so glad because we got to wrap this up because this ends on its own. So what one of the things I want to wrap up with is I have a thrifty listing plan. I think I've told you about it. And oh, I got to hear her. I can't hear you.
I'm sorry,
It's
something
okay.
happened to my computer. I'm sorry.
You know, it's technology, darling. We all been there. You know, we're happy to have you back. So my thing is, you know, I am encouraging my sellers with my thrifty listing plan to help with the buyer's closing costs. Do you think this is effective? Better than buying down the rate?
Well, it depends on the buyer, but most buyers that are putting a minimum down payment of 3.5%, 5%, 10%, they do need help paying for closing costs, especially when they're much higher. So I would say I would rather have someone pay my closing costs than buying down the interest rate and still needing that extra money on top of the closing cost.
Yeah. So I'm glad to hear that.
Yeah.
And then I love this. I'm going to wrap it up with this because I saw this and I think it's true. I want your take on it. It's don't let yourself miss an opportunity. If you see a house that you love, don't miss that opportunity, right? Don't marry the house, date
the rate. Yes.
And because you can always refinance.
That's correct.
You're not going to have that interest rate, even if you feel like it's a little on the higher side. If they do come down, you can always refinance, right?
That's correct. And the values in Florida are stable. Many people are moving here. And things you see in the media about markets going down, you know, every state is different. And Florida, everyone wants to live in Florida. So we still have low inventory, and I think the values are stable here in Florida. So
I do too. I really think that's why I changed it to a challenging market. I think you've given people a lot of great information. Ruth feels like she really benefited. She is a legitimate future home buyer because she has to do some of the things that you've recommended to do to make her in a position to buy. So you really helped her.
I have the credit score, but the reportable income, that steady reportable income might be the catch, but I have a considerable for down payment. So yeah, for sure.
All right. Well, listen, I really appreciate that you took the time to do this with me, Debra. If you need help with financing, I'm going to have all of Debra's information in the description. If you need to get a home loan, this is who you want to be in touch with. Debra Harper with Element Home Loans. Thank you again.
Thank you.
I really appreciate that you took the time to be with us today.
Thank you so much for inviting me. It was a pleasure.